and go about your day. Only on TuneIn.
Deep left center field. A grand slam!
October baseball is here, and TuneIn Premium is your ticket to the 2019 MLB postseason. Featuring the home and away feeds for every game, TuneIn Premium delivers every call of the ALCS, NLCS, and the 2019 World Series through the voices of the local radio broadcast teams.
Air, left field and deep. He's at the wall.
Now until a new champion is crowned, hear every play of the 2019 MLB postseason live on TuneIn Premium. Upgrade today.
It's Liz Hernandez with your TuneIn Music News Update. Taylor Swift tells Rolling Stone magazine that living a quiet life still causes drama. She says, "I decided I needed to live a quiet life. I didn't realize I was inviting people to feel they had the right to sort of play my life like a video game." Meanwhile, the Daily Mail claims Ed Sheeran has donated 18 pairs of his old slippers to charity. Most of the Nike, Dolce & Gabbana, Converse, and Air Jordan slippers are expected to sell for as much as $250 a piece. For music from Taylor Swift and Ed Sheeran, search today's hits on TuneIn.
The problem with traditional cotton sheets is that they trap heat and moisture. That's not how you get a great night's sleep. So we invented Chic's Performance Sheets. As elite athletes, we personally experienced how technical fabrics improve athletic performance. So we applied that same technology to bed sheets. We created revolutionary sheets, which can do all the things that cotton can't.
Before Chic's, I slept warm and sometimes a little sweaty at night. And now with Chic's, I stay at the perfect temperature all night long.
In this steam demonstration, you can see how Chic's breathes 10 times better than cotton, releases heat, and wicks moisture to keep you dry as you sleep. Cotton will never do that. We all sweat a little bit when we sleep. Chic's quickly moves moisture away from your body and will keep you dry. Cotton won't.
The moisture wicking technology in Chic's keeps me cool all nights where I don't wake up in the middle of the night with that damp bed.
Chic's are easy to clean and wrinkle-free, straight from the dryer to your bed. In this stretch and fit demonstration, you can see just how much Chic's stretches and how it will conform to fit any size bed, no matter how thick the mattress. Cotton definitely can't do that.
Chic's are as soft as you can imagine. They're just incredible. I've never felt a sheet that soft before.
We're proud of what people are saying about Chic's. Our bed sheets are so unique that they're patented. Only Chic's can say that. We guarantee Chic's will be the best sheets you'll ever own.
Call or go to trychic's.com now to sleep better every night. Order your Chic's Performance Sheet Set in your choice of size and color. For a limited time, you'll get 25% off when you use the promo code on your screen, plus 2 additional pillowcases at no cost. That's a total savings of up to $100. Act now to get free shipping. Sleep on Chic's for 30 nights, and if you're not satisfied, we'll give you a full refund. There's no risk. Call or go online now and see how Chic's deliver the ultimate deep sleep experience. Sleep cool, sleep dry, sleep comfortable. Chic's.
Where big tech meets the street.
Investors clearly want a piece of the action.
Are some type growth stocks coming back into vogue? Squawk Alley is live.
Carl Quintanilla, Morgan Brennan, John Ford. Squawk Alley, 11 a.m. Eastern on CNBC.
Last year, pot stocks were the talk of Wall Street as more and more states got on board with recreational marijuana. But this year, the narrative is very different, and the recent vaping crisis is playing a big role. Since the launch of the CDC's vaping illness investigation in August, cannabis stocks have been crushed. Just look at the big names like Canopy Growth, down 30%. Tilray is down 40%. Joining me now is Michael Lavery. He's senior research analyst for Piper Jaffray, covering both of these sectors, cannabis and tobacco. Michael, it's great to see you again. So why is the crackdown on vaping hitting the pot stocks?
Thank you. Well, it's hard to tell the exact correlation, but certainly there appears to be at a minimum consumer uncertainty. Ironically, there's a bit of an opportunity here. If it is black market products that are clearly and definitively causing the illnesses, then it should favor these regulated players and actually steer consumers in that direction. But at the moment, the authorities that are investigating just haven't been able to pinpoint it precisely enough to say that in a way that gives consumers the comfort they would need.
Even if it is black market products, does it still pose a threat to the viability of some of these cannabis plays going forward, meaning how the regulators might come down on it?
One of the reasons vapor is important to the cannabis industry is that in states in the U.S. where it's been state legal for some time, it tends to be about 25 to 30% of the category. So it's a large segment. And for anyone who's interested in the category but not looking to smoke, it can be a more approachable form factor for them. So it is a piece of the puzzle that matters, and that's where what the regulators decide really makes a difference. Keep in mind that for the Canadian operators, they're still a couple months away from having vape markets legalized in that country at all. It isn't yet in the market there, and that's something that we'll be watching how consumers respond, assuming that proceeds as planned.
Yeah, I understand that Canopy and Green Thumb Industries are a couple of the names that you would favor in your coverage universe. Why is that?
One of the things that's coincided with these vaping headlines is a focus from some more of the top line growth to the earnings and cash flow of the operations. And so while investors still care about the top line growth, the retail rollout in Canada has been a little bit slower than expected. That's forced investors' attention a little bit more on what the earnings and execution and discipline looks like. We've highlighted Kronos and Canopy as two names that have very strong balance sheets due to the cash infusions from their strategic investment partners, and then Green Thumb also has sustainable operations and wouldn't need a cash injection to keep going. A lot of other companies in the space aren't quite as fortunate.
You know, what does it mean when you have a lot of these major companies, Kroger being the latest example, coming out and saying they're going to stop selling e-cigarettes at their stores? You know, again, I understand the overlap there. They're trying to target a product that they think has really hooked teens and prevent that from, you know, engendering a larger blowback. But if this product gets pushed in general out of mainstream channels, where is it likely to go? Whether it's going to ultimately be e-cigarettes or if you're vaping cannabis products?
Certainly for both sectors, it's a question that matters, because if the black market products are indeed truly the issue, as seems most likely to be the case, then in some respects, the worst thing to do is to give consumers a greater incentive to seek those out and to restrict the legal ones. But understandably, retailers and authorities who are regulating the nicotine products certainly don't want to be on the front lines of a new problem. It's early, and everyone's trying to do what they can to nip something in the bud.
Michael, it's really interesting. Thanks so much for joining me. Appreciate it.
Thank you very much.
Michael Lavery is with Piper Jaffray. That does it for the exchange today. Thanks, everyone, for your time. I will go join Tyler and Melissa for Power Lunch, which begins right now.
Thanks, Kelly. We'll see you soon. I'm Melissa Lee. Here's what's new at 2 on Power Lunch. Wall Street feeling the heat as tensions between the U.S. and China reach a fever pitch ahead of trade talks this week. Will either side back down? Plus, with the markets on edge, we are just 30 minutes away from Fed Chair Jerome Powell delivering a speech that could determine the fate of this market. We'll bring you all the details. And later, General Motors strike revving up as it's now in its 4th week. We'll talk to the head of one county in Michigan that is feeling the pinch. Power Lunch starts right now.
Hi, everybody, and welcome to Power Lunch. I'm Tyler Madsen. Let's take a look at where we stand with the market. Stocks are falling, but they are well off the lows of the day when the Dow was down more than 300 points. The Russell 2000 faring the worst as small caps get hit particularly hard, down 1.25%. Let's check out the Dow laggards. Cisco, Dow, IBM, JP Morgan, they are among the biggest losers right now. For more on today's declines, let's go to Bob Pisani, the New York Stock Exchange. Hey, Bob.
Hello, Tyler. It's another tough day for the markets. You can't blame them. Now, remember all this optimism on Friday? The jobs report helped dispel some of the concerns about recession. Didn't get rid of them. The market started this week expecting some positive news on trade. And instead, what we really have here is the opposite. We've got an escalation of the trade war. And predictably, that's pressured the usual names, semiconductors and other cyclical names like banks and materials and retailers. The problem is the market's increasingly coming to believe that a trade deal, even an 80% trade deal, may be unlikely this year. That's a big problem. It means potentially lower growth in 2020. It means flat to lower interest rates. It means flat to lower oil, and a continuing emphasis on owning the defensive sectors, those utilities, those REITs, those consumer staples that have been so much a standout this year and are so expensive. Logically, they are the standout sectors this year, of course, even while a staunch group of supporters believe semiconductors are going to continue to grow regardless of the growth issues that are out there. So this narrative means stocks are expensive right now, number one, and that the fourth quarter guidance, if this uncertainty continues, is not going to be positive overall, may even be negative. That's why bulls want to reverse this whole narrative I just explained to you, but they don't know how to do that without a more positive trade story. It's a real problem, Kelly, for the markets. Back to you.
Okay, Bob, thanks very much. Bob Pisani. The biggest drag on stocks today, fading optimism about this week's U.S.-China trade talks. Let's get to Kayla Tausche, who has the latest from Washington on how that is developing. Kayla?
Hey, Kelly, tensions have been building ahead of high-level talks Thursday, with White House officials mulling restricting certain Chinese securities from federal pension portfolios. Then you have 3 Chinese tech companies in the MSCI All-World Index being eyed in that decision that are now banned from doing business with U.S. suppliers without a license. It's auspicious timing for rolling out that policy since it's been months in the making. Then you have tariffs rising again on Tuesday, and China saying it would retaliate on many fronts. It's halting of NBA broadcasts, no coincidence there. Perhaps all to set the negotiating table here. State-affiliated Global Times says the size of China's delegation signals it wants a comprehensive deal. But a top editor there tweeting that Chinese people now believe that alternating trade war and trade talks will just be a normal thing between China and the U.S. going forward. Yesterday, though, President Trump seemed to leave his options open.
I think that we just have to see what happens. I would much prefer a big deal, and I think that's what we're shooting for. Can something happen? I guess maybe. Who knows? But I think it's probably unlikely.
Larry Kudlow said he sees progress potentially happening this week. Peter Navarro said it's a big deal or no deal. So you have some mixed messaging from the Hawks and the Doves in the White House. And in recent weeks, you've had some mixed messaging from the president himself. But we'll see what the Chinese put on the table and how the U.S. ends up viewing it. Melissa?
Kayla, thank you. Kayla Tausche. Last hour on the exchange, Kelly asked if Tiffany, Gap, and the NBA's decisions to bow to political pressure from China was the right move. 84% of respondents said no. Does this bode poorly for the chances of getting a trade deal done during this week's round of talks? And is there a situation in which the U.S. consumer follows their hearts with their wallets when it comes to American companies doing business in China? Let's bring in Hamilton Place Strategies founding partner and CNBC contributor Tony Fratto. Tony, great to have you with us. Kayla was saying how there are so many mixed messages coming out of the White House, and at the same time we have this backdrop of what appears to be increasing tensions, whether it be government pensions and whether or not they're allowed to invest in Chinese stocks or the NBA. I mean, what do you think happens here?
It's adding a lot of complexity to what is, I think, already among the most complex trade agreements that you can try to negotiate. And one of the things that happens with the NBA issue is all of us on CNBC or in DC, we spend a lot of time on politics and economics. Culture trumps both of those in the minds of people and consumers. So it does cross over into areas where consumers, people going into retail shops, start to think about those things. Now, we haven't seen that kind of thing happen in the past here. We have seen that kind of thing happen in China, though, and so it's a real risk for American firms that are doing business over there.
From the market standpoint, Tony, I think the biggest question is whether or not there will be relief from tariffs and whether or not the next tranche of tariffs will go into effect. Do you think we'll get progress on that, or will that remain something that's in play, even if there are agreements that are reached at the table, simply because the U.S. will have little leverage to make sure that China actually complies with anything that is agreed upon unless there are things like tariffs in place?
Yeah, that's true. I think a comprehensive agreement is nearly impossible to do with all of these things that are being thrown into the bucket right now. And it's it's always going to be difficult. You throw in the national security issues, makes it really hard to negotiate. And then I also think you have the issue of President Trump going through this impeachment process right now, and him looking as a weak person. So I think a weak leader, and the Chinese questioning who are they actually negotiating with? Are they negotiating with someone who's actually going to be there tomorrow? So that's an issue. I think they do want to get some kind of an agreement. It would bring a lot of relief on both sides of the Pacific, and in those economies and in markets. I think markets would rally even on a really skinny kind of an agreement, and that would bode well for continuing talks in the future. I think that's the best that we can hope for right now. It's not a slam dunk that that's going to happen, though, because of some of these issues that have cropped up over the past week that Kayla ran through.
Obviously, Tony, the Chinese do not like to be lectured. They do not like to be told what to codify in their laws with respect to, for example, the protections of intellectual property. Let's set that aside for the moment. I'm interested in hearing you describe what you would tell American businesses about what they or their employees can fairly and safely say about Chinese quote, domestic politics while they continue to do business there. It's not as if Hong Kong is the first sort of evidence of foul play on the part of the Chinese government that we're aware of.
No,
they have been persecuting the Tibetans, they have been persecuting the Muslims, and they have lots of political prisoners, and yet dozens of American companies do billions of dollars of business within that country every year.
Yeah. Look, I think it's unrealistic to tell global American corporations not to do business in China, and it's also unrealistic to tell their employees that you can't use your voice. They are, at the end of the day, American companies. I will tell you what we tell our clients and we tell American companies is to set your principles. What are your principles? And be open and public about them. Publish them. Tell the Chinese and others what principles you have for what your expectations are for your managers and your employees, and just be very clear about it and go into those markets based on those principles. And you can have a really good discussion about them, and I think you could do them in a way that the Chinese will actually understand them. It's difficult for firms like the Siemens of the world and the big retailers and Boeing and
Microsoft, the John Deere, General Motors. They have global competition. My issue here with the NBA is essentially a monopoly. There's only one NBA in the world. There's not a clear number two. The number two is 100 steps down relative to the NBA. The NBA actually has some power here. The problem with the NBA is that they're uneven in what they expect from their people and their teams. So you can't criticize China, but you can criticize Turkey. And a general manager isn't allowed to say something, but a player is allowed to say something. And so they're not clear on what their principles are and what they're about. I know that they have tried to come out with a couple statements now to clear that up, and they haven't quite done it, but they needed to go in as their business model, as their business strategy, knowing what those principles are and the expectations are. We're all hopped up about this issue, and you look on any cable news channel right now, you will see this debate taking place across the board.
Yeah.
Let's be clear here. Daryl Morey was speaking as Daryl Morey. He wasn't speaking on behalf of the Houston Rockets, clearly. He wasn't speaking on behalf of the National Basketball Association. So how long does this story play out before another shiny object comes along and we're all distracted and it goes away?
Well, it could happen soon. I mean, because these things are happening every day, and they're big, and we as Americans care about these kinds of issues just as much as if the Chinese we know that they care about Hong Kong, we care about freedom and democracy. I'll tell you the Chinese Canadian owner of the Brooklyn Nets said some things about the situation that offended me, and we don't look at it and say, well, he shouldn't be allowed to say those things and NBA's got to shut him up. We say, no, in America, you could say what you believe. So there are sort of foundational principles that we believe in, and so the firms need to go into these markets clear on those things and public about them, and so there are no surprises.
Tony, thanks as always. Love hearing from you.
Same. Thank you.
Tony Fratto. All right. Escalating trade tensions with China weighing heavily on the markets, especially earlier today. Will earnings season be the next shoe to drop? Mike Ryan is the CIO of the Americas with UBS Global Wealth Management. And John Stolfus is Chief Investment Strategist with Oppenheimer Asset Management. Gentlemen, welcome. Let's talk China and trade here. Mike, is the market basically just waiting to see what happens at these trade talks on Thursday, Friday, and into the weekend?
Yeah, I think, first of all, I think what Tony said was really important. He kind of laid out this issue about just how complex and how multifaceted some of these trade issues are. So the notion that we're going to have some big grand deal and it's easily solvable over a weekend, I think we have to dampen our expectations on that. What I think markets are looking for, though, Tyler, is some sense as a framework put in place that we can continue negotiations and that we can begin the process of de-escalation. So I think that's what we're going to look for out of the trade negotiations, for the balance this week into the weekend.
John, an awful lot of people believe that we're going to be in a state of trade tension and geopolitical tension with China, not just for the next few months, but for the next years and maybe even decades, and that is just something we're going to have to get used to. Do you agree with that?
No, I don't. I think it's very hard to tell what's going to happen 3 to 6 months out on something like this. I think we're working up, Tyler, to a crescendo of some kind. with both sides expressing their grievances to each other fairly without not withholding anything. I think people are drawing a lot of lines in the sand. But ultimately, we think for China, the biggest problem is every day that it doesn't have an agreement with the U.S., more companies around the world, and not just U.S. companies, begin to diversify their supply chain away from China.
And obviously, lines in the sand can get washed away in the next tide, John.
I think so, Tom. I think you can't count on that. And if anything, it's a dynamic situation that, based on the pain consumers in China and in the United States could feel from a full second year of trade war, we think the effects of that are being reverberated in the halls of leadership in both countries. And so we think we're just reaching a crescendo here. We do agree with the thought that this is a much longer process than many people thought from the beginning. But Wilbur Ross gave us the signal on that, as I recall, when he said the complexity of this thing about a year ago on CNBC. This is going to take some time. There's so many issues, and fundamentally, from an ideological perspective, there's a huge moat between both countries that's got to be worked out.
Mike, the longer this goes on, John was talking about companies diversifying their supply chains. I'm thinking more like companies not wanting to spend. I mean, we're already expecting CapEx to only go up 3% for the third quarter. And I'm just wondering, Mike, from your perspective, what are you concerned about? What are you looking for specifically out of third quarter earnings calls, the earnings conference calls in terms of commentary that will make you feel either better or worse? I mean, what are some of the things that you'll be watching?
Let me hit first on what you talked about in terms of this notion about business confidence. Our views have been that it was the first order effects from the trade conflict were not material enough to throw the global economy, certainly not the U.S. economy, into recession. It's a second and third order effects. What does it do to business confidence? What does it do to business spending? This has already been the slowest business spending cycle of any expansion in U.S. history. So the notion now that we have this uncertainty around trade, which is causing business leaders to pause in terms of what they're going to do going forward in terms of their forward commitments, that's obviously more of a concern. Now, we're not seeing a whole lot of guidance in terms of companies saying that this is fundamentally altering their plans over the course of the next couple of quarters. But obviously, the longer the stretch is, the more the risk there is that it creates additional uncertainties, that there's more of a pause, not only in terms of their spending plans, but also potentially their hiring plans as well.
All right, Mike, thank you very much. John Stolfus, thank you as well. Mike Ryan of UBS. John Stolfus, we appreciate it.
Coming up on Power Lunch, Jay Powell speaking at 2:30 p.m. Eastern Time. We're going to take the remarks from the Fed chair live. But first, we are 23 days now into the GM strike, and it's showing no signs of ending anytime soon. We're going live to Michigan for a look at the huge economic and maybe political impact the strike is having. Stay with us.
This CNBC program is...
Get ready for Brexit on the 31st of October. This means that travelling to the EU will change. You'll need to check online if your passport is valid for travel to Europe. If you're planning on driving, you'll need to check if you have the right documents to drive. And make sure your travel insurance covers all your healthcare needs. To keep your trip on track, check what you need to do at gov.uk/Brexit. Get ready for Brexit on the 31st of October.
The nights have started to draw in. And at DFS, we know that can only mean one thing. Everyone will want to spend more time at home, getting nice and cozy. Ah, you can't beat it. That's why all our sofas are handmade to order, and many are guaranteed to be delivered in time for Christmas. So you can look forward to cozying up this winter, knowing your new sofa won't let you down. DFS.
You're 169 in the queue.
I proposed on the 169. She got for the next stop.
You're my 169th greatest lover.
The number 169 never screamed going places until now. Get the Toyota Aygo X-Play for only £169 deposit, then £169 a month with 0% APR representative. Just go. Aygo.
0% APR representative on new sales of Aygo X-Play over 48 months. £169 per month. Customer deposit of £169 when proposed and approved via Access Toyota by 31st of October 2019. £3,487.50p optional final payment. Subject to status to over 18s. Indemnities may be required. Conditions apply. Toyota Financial Services.
We are in the fourth week of the GM strike now, as negotiations with United Auto Workers have hit a major speed bump. The ripple effects from the strike have ravaged GM's share price, which is down more than 10% during this time, and another 2.5% today. It's also ravaged many communities relying on this company. We bring you to a county in Michigan that has been hit hard, where GM employs around 20,000 full-time workers. It's about 5% of its total workforce. Joining us now is Mark Hackle. He's executive to Macomb County. And Mark, welcome. Thanks for joining us.
Thanks for having me on the show.
I guess a lot of this depends on how long the strike lasts. What fallout are you seeing already from it?
Well, there was some immediate impact that took place with some of the companies or facilities. It was like day after they actually decided they were going to go on strike, some of these facilities had to start laying some folks off, and so they did. Some of the other ones that had contract work with General Motors, they're still trying to figure out what to do, and it's kind of a progression of layoffs that's taken place. So it really has hit hard. Just last Friday was what we call National Manufacturing Day. We celebrated it. We went to some of these facilities, the Tier 1, 2s, and 3 suppliers, and I tell you, walking through them, it was kind of sad. You started realizing that those layoffs have already impacted those companies.
You said you guys were the number one county in the country with the highest manufacturing job growth. So obviously, this being an important engine for the entire area means that there's going to be a lot of ancillary layoffs, so to speak. What can you tell us about that? I mean, what's the trickle-down effect that we're already seeing from this lasting more than a month? How important is it for these talks to be resumed quickly?
Well, if you think about it, as you just mentioned, being number one job growth in the entire country, and there's 31 other counties that are out there that were competing for this, I guess, title, if you will. Macomb County being recognized as that one. Wow, what a huge asset that was for us to kind of get out from underneath. Because about 8 years ago, we were fighting for manufacturing jobs, trying to figure out if that was going to be something we're going to have to retool ourselves on. But we didn't. Manufacturing was alive and well. Moving forward, the concern is going to be, are some of these facilities, are they going to close up shop and stay closed up? So we're really starting to feel those repercussions.
Already in the first 3 weeks of the strike, Macomb County has lost $412 million in wages. How has that trickled down to the local community?
You're starting to realize it. I mean, even the mom and pop stores, the restaurants that are taking place. I was just in one that happens to be what's called a kebab house, right in the epicenter where General Motors Tech Center is at. And normally that place is packed during the lunch hour. I walked in there and it was about a quarter full. So 3/4 of the place was actually empty. And that's not the norm. Normally you're seeing a lot of people there and they're starting to feel the impact and they're talking about it. So they're hoping these workers get back to work. But again, it's going to take a little bit of input on behalf of General Motors to work with them to figure out how do we solve this contract debate.
You also said you think it's surprising that President Trump hasn't tried to stir this issue up. What do you mean by that?
Well, all the Democratic candidates have been in Macomb County. And so having been in Macomb County and standing along the picketers, knowing that Macomb County was basically something that swayed the election toward Donald Trump, during that last election cycle, which may have swayed the state and may have even swayed the election. We hear about that quite often. It is kind of surprising that he himself isn't here at some point in time or even talking more about, General Motors settling the strike on behalf of the workers.
So you think he should come out in support of it and maybe get this resolved?
Well, as a Democrat, I don't know that I would recommend him to do what he would need to do to win Macomb County. But let's face it, anybody that wants to win over Macomb County is going to have to win over the workers in Macomb County. And again, a lot of them are from the manufacturing. They want to know who they're going to trust to help them maintain jobs and some good wages moving forward. So they're going to be voting. There's no question about it. Who they vote for is going to be dependent upon who they trust is really going to help them with their issues.
Pretty big ripple effect from your area to the whole country. Mark, thanks very much for joining us.
You bet. Thanks for having me.
Mark Hackle.
We're just about 3 hours away from the next decision on actually the release. 3 weeks away from the next Fed decision. That's right.
You just can't wait. You're just so excited about
I got this countdown clock in my house.
You do, right?
This is a live shot of the wall of my living room. In just a few minutes, we'll hear from Jay Powell in one of his last public speeches before that meeting. Will he drop any hints about the Fed's next move? Stay with us.
London, switch to Vodafone, the UK's best mobile network, and be unlimited, because the best phones deserve the best network and our new unlimited data plans. The future is exciting. Ready? Vodafone.
Max download speeds apply to unlimited data. Best network as voted by readers of trusted reviews. Terms at vodafone.co.uk/unlimited.
Hey, it's me again, the TV. Since my family gave me Now TV, there's no more endlessly searching for something they want to watch, because now I don't do filler TV, just killer TV. If my family want movies, I've got Blockbusters. Football, how about the Premier League? Or how about crime dramas? I've got loads, and they're never going to guess who did it. Now they can watch whatever they're in the mood for.
What's your TV got for you tonight? Now TV. 18 plus, month passes auto renew, terms apply.
Can I have chemo at home?
It's only suitable for a couple of types of
cancer.
When you search one question about cancer, you end up with millions of results which contradict each other. For clear and uncomplicated information, come to Cancer Research UK. Visit us online or give us a call on 0808 800 40 40. Cancer Research UK. Together, we will beat cancer.
The MLB is in full swing.
Looking up, and this one is up and out. A home run.
Swung on and into the air to deep left. That ball is high. That is far. That is gone.
To listen, just search MLB Today on TuneIn Premium so you don't miss a moment of the games on TuneIn.
From the TuneIn Studios, I'm Fonseca with your daily sports update. Major League Baseball Division Series continues. We've got Game 4. The Astros at the Rays. That's at 4:15 p.m. Eastern. The Houston leads 2-0 right now.
Our best games that we've played during the postseason, we strung at bats together, and it's trying to put up a good at bat for the next guy. If we keep continuously putting up good at bats, the next guy will come through. When we have that mindset, we're a really, really, really good offense.
Find this game, search MLB, and favorite your team. That's your TuneIn Sports Update.
MSNBC is on TuneIn. Get up-to-the-minute coverage on news and events from around the world with MSNBC's live 24/7 station on TuneIn. At home or on the go, stay up to date on the latest news and political trends with MSNBC's full lineup of shows, including Hardball with Chris Matthews.
Hi, I'm Chris Matthews. Thanks for listening to MSNBC on TuneIn.
And The Rachel Maddow Show. Plus, when news breaks, MSNBC has you covered with live updates, expert analysis, and more. Search MSNBC on TuneIn today.
Welcome back, everyone. I'm Sue Herrera. Here's your CNBC News update at this hour. House Republicans publicly slamming House Intelligence Committee Chairman Adam Schiff's impeachment investigation as biased after he made a statement about European Union Ambassador Gordon Sondland not appearing for a deposition this morning.
We fully understand why the administration made the decision they did. When you're going to have a chairman release certain parts of what was said in a closed-door interview and not release the entire transcript and give it context, you can see why they didn't want to subject Ambassador Sondland to the same kind of treatment.
Target is partnering with the company that owns the Toys R Us brand to relaunch ToysRUs.com. Starting today, shoppers who visit Toys R Us online will be redirected to Target.com to complete their purchases. And Lego is looking for ways to recycle its plastic bricks. It's testing options for customers to ship back their unwanted pieces for free. The company would clean the bricks and then give them to the nonprofit Teach for America, which would donate them to classrooms around the country. Everybody look in those couch cushions. That's the news update this hour. Guys, I'll send it back to you, Ty.
All right, thank you very much. Sue, we are just a minute or two away from hearing from Fed Chairman Jay Powell, and we will bring that to you live. It is probably his last public remarks before the next Fed meeting. You'll want to hear them, and we've got them. Don't go anywhere.
Each day,
when it comes to keeping your small business valuable information safe, Dell Small Business Technology Advisors can recommend tailored security solutions like computers with Intel Core processors, servers, storage, networking, plus industry-leading monitors and software. Running your own small business is a big challenge, but with the right partner, it's a lot easier. To speak with an advisor today, call 0800 085 4878. That's 0800 085 4878.
London, switch to Vodafone, the UK's best mobile network, and Be Unlimited, because the best phones deserve the best network and our new unlimited data plans. The future is exciting. Ready? Vodafone.
Max download speeds apply to unlimited data. Best network as voted by readers of trusted reviews. Terms at vodafone.co.uk/unlimited.
Good. Here's a swing and a drive deep to right field. Looking up. Goodbye, baseball.
Between game-winning shots and walk-off homers, follow TuneIn on social media to discover the latest and greatest in live sports.
With the 24th pick in the 2019 NFL Draft.
From live reminders that the biggest MLB games are on the air, to recommendations of the best new sports talk shows and podcasts.
He's going to be fine. He's going to be good right away in 3 years.
Follow at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
In the dictionary, a podcast is this: a digital audio file made available on the internet, typically as a series, of which new installments can be received by subscribers automatically. But on TuneIn, a podcast is this.
I'm Rachel Martin with David Green, and this is Up First from NPR News.
And it's defined like this.
Ladies and gentlemen, welcome to the show.
From news, sports, to pop culture, comedy, and beyond. Define your own podcast possibilities on TuneIn.
MLB is right here on TuneIn.
A swing and a drive to right field. That's it. Well, Ramirez back, and that ball's gone.
And to find it all, you need to search MLB on TuneIn.
By the wall, out of here.
Home and away calls are a click away on TuneIn Premium.
It's Liz Hernandez with your TuneIn Music News Update. Kelsey Ballerini and Halsey are doing a CMT Crossroads together. And not surprising, since Kelsey posted clips of them doing karaoke. They're taping the episode on October 11th, and it'll air early next year. Speaking of country collaborations, Tim McGraw posted a video on Instagram of what looks like him and Shy Carter rehearsing in an empty arena. They're on stage performing their new song, Way Down. To hear music from Kelsey Ballerini and Tim McGraw, search Country Roads on TuneIn.
Welcome back to Power Lunch. Let's check on the markets before we hear from Fed Chair Jay Powell. The Dow is down 330 at the lows. We're off 160 right now. NASDAQ still the worst performer, down almost 1%.
We've got breaking news. Fed Chairman Jay Powell speaking in Denver today. It'll be one of the last times we hear from him before the next Fed meeting later this month. Steve Leisman is here to tell us what Powell might or might not say. Steve.
Is he speaking in Denver right now? He is speaking, so we can tell you that he will say that the Fed will soon begin buying new securities, that is growing reserves and the balance sheet. They've talked about this before and said it was likely to happen, but Powell saying definitively it will happen. Says the Fed is contemplating buying Treasury bills. Doesn't say bonds, says bills specifically.
To steepen the yield curve?
No, this is in order to solve this repo problem that's been out there with a lack of reserves in the system. He says do not confuse what's going on with the Fed balance sheet as QE or quantitative easing. It should not have a market effect on monetary policy per se. However, on the issue of monetary policy, he says the Fed will act as appropriate. It's phraseology he's used quite a bit before, and says monetary policy is data dependent. He doesn't say that once or twice. 7 times in the speech he says the Fed is data dependent, which is the title of the speech as well. Says policy is never on a preset course. On the economy, Powell will say jobs and inflation picture are both favorable, but there are risks to the outlook from weak global growth, from trade, and from Brexit as well. Maybe he also says that job growth is solidly above the pace required to accommodate workforce growth, even though now it's more moderate than it has been, and recent job gains because of other revisions could be revised lower. Even then, he says, it won't necessarily be a problem, because he says we're still going to be above the level needed to accommodate growth in the workforce. I didn't say, guys, should I take him there, or are we going to?
We'll go right there.
Listen
to Chair Powell.
Yeah. You stay here.
Never seems far from relevance, is again drawing out our attention after recent events in the Persian Gulf. While the question is familiar, technological advances in the energy sector are rapidly changing our assessment of the answer. Second, with terabytes of data increasingly competing with truckloads of goods in economic importance, what are the best ways to measure output and productivity? Put more provocatively, might the recent productivity slowdown be an artifact of antiquated measurement? Third, how tight is the labor market? Given our mandate of maximum employment and price stability, this question is at the very core of our work. But answering it in real time in a dynamic economy, as jobs are gained in one era but lost in others, is remarkably challenging. In August, the BLS announced that job gains over the year through March were likely 500,000 lower than previously reported. And I will discuss how we're using big data to improve our grasp of the job market in the face of such revisions. These 3 quite varied questions highlight the broad range of issues that currently come under the simple heading of data dependence. And after exploring them, I will comment briefly on recent developments in money markets, and on monetary policy. So our story of data dependence in the face of change begins when the Fed opened for business in 1914. World War I was breaking out in Europe, and over the next 4 years, the war would fuel profound growth and transformation in the U.S. economy. But you could not have seen this change in the gross national product data. The Department of Commerce did not publish those until 1942. The Census Bureau had been running a census of manufacturers since 1905, but that came out only every 5 years, an eternity in the rapidly changing economy. In need of more timely information, the Fed began creating and publishing a series of industrial output reports that soon evolved into industrial production indices. These indices initially comprised 22 basic commodities, chosen in part because they covered the major industrial groups, but also for the practical reason that data were available with less than a 1-month lag. The Fed's efforts were among the earliest in creating timely measures of aggregate production. And over the century of its existence, our industrial production team has remained at the frontier of economic measurement, using the most advanced techniques to monitor U.S. industry and nimbly track changes in production. So turning to the three questions. The first is the consequence of an oil price spike. Figure 1 shows U.S. oil production since 1920. After rising fairly steadily through the early 1970s, production began a long period of gradual decline. By 2005, production was at about the same level as it had been 50 years earlier. Since then, remarkable advances in the technology for finding and extracting oil have led to a rapid increase in production to levels higher than ever before. In 2018, the United States became the world's largest oil producer. Oil exports have surged, imports have fallen, and the U.S. Energy Information Administration projects that this month, for the first time in many decades, the United States will be a net exporter of oil. As policymakers, we closely monitor developments in oil markets because disruptions in these markets have played a role in several U.S. recessions, and of course in the great inflation of the 1960s and 70s. Traditionally, we assessed that a sharp rise in the price of oil would have a strong negative effect on consumers and businesses, and hence on the U.S. economy. Today, a higher oil price would still cause dislocations and hardship for many, but with exports and imports nearly balanced, the higher price paid by consumers is roughly offset by higher earnings of workers and firms in the U.S. oil industry. Moreover, because it is now easier to ramp up oil production, a sustained price rise can quickly boost output, providing a shock absorber in the face of supply disruptions. Thus, setting aside the effects of geopolitical uncertainty that may accompany higher oil prices, we now judge that a price spike would likely have nearly offsetting effects on U.S. GDP. Turning to the second question of how to best measure output and productivity. While there are some subtleties in measuring oil output, we do know how to count barrels of oil. Measuring the overall level of goods and services produced in the economy is fundamentally messier because it requires adding apples and oranges and automobiles and a myriad of other goods and services. The hardworking statisticians creating the official statistics regularly adapt the data sources and methods so that, insofar as possible, the measured data provide accurate indicators of the state of the economy. Periods of rapid change present particular challenges, and it can take time for the measurement system to adapt to fully and accurately reflect the changes in the economy. The advance of technology has long presented measurement challenges. In 1987, Nobel Prize-winning economist Robert Solow quipped that you can see the computer age everywhere but in the productivity statistics. In the second half of the 1990s, this measurement puzzle was at the heart of monetary policymaking. Chairman Alan Greenspan famously argued that the United States was experiencing the dawn of a new economy and that potential and actual output were likely understated in official statistics. Where others saw capacity constraints and incipient inflation, Greenspan saw a productivity boom that would leave room for very low unemployment without inflation pressures. In light of the uncertainty it faced, the FOMC judged that the appropriate risk management approach called for refraining from interest rate increases unless and until there were clearer signs of inflation. Under this policy, unemployment fell near record lows without rising inflation, and later revisions to GDP measurement showed appreciably faster productivity growth. This episode illustrates a key challenge in making data-dependent policy in real time. Good decisions require good data, but the data in hand are seldom as good as we would like. Sound decision-making, therefore, requires the application of good judgment and a healthy dose of risk management. Productivity is again presenting a puzzle today. Official statistics currently show productivity growth slowing significantly in recent years, with growth in output per hour falling from more than 3% a year from 1995 to 2003 to less than half that pace since then. Analysts are actively debating three alternative explanations for this apparent slowdown. First, the slowdown may be real and may persist indefinitely as productivity growth returns to more normal levels after a brief golden age. Second, the slowdown may instead be a pause of the sort that often accompanies fundamental technological change, so that productivity gains from recent technology advances will appear over time as society adjusts. Third, the slowdown may be overstated, perhaps greatly, because of measurement issues akin to those at work in the 1990s. At this point, we cannot know which of these views may gain widespread acceptance, and of course, monetary policy will play no significant role in how the puzzle is resolved. As in the late 1990s, however, we're carefully assessing the implications of possibly mismeasured productivity gains. Moreover, productivity growth seems to have moved up over the past year after a long period at very low levels. We do not know whether that welcome trend will be sustained. Recent research suggests that current official statistics may understate productivity growth by missing a significant part of the growing value we derive from fast internet connections and smartphones. These technologies, which were just emerging 15 years ago, are now ubiquitous. We can now be constantly connected to the accumulated knowledge of humankind and receive near instantaneous updates on the lives of friends far and wide. And adding to the measurement challenge, many of these services are free, which is to say, not explicitly priced. How should we value the luxury of never needing to ask for directions? Or the peace and tranquility afforded by speedy resolution of those contentious arguments over the trivia of the moment? Researchers have tried to answer these questions in various ways. For example, Fed researchers have recently proposed a novel approach to measuring the value of services consumers derive from cell phones and other devices based on the volume of data flowing over those connections. Taking their accounting at face value, GDP growth would have been about a half percentage point higher since 2007, an appreciable change, and that would be very good news. Growth over the previous couple of decades would also have been about a quarter percentage point higher as well, implying that measurement changes of this sort likely account for only part of the productivity slowdown in the current statistics. Research in this area is at an early stage, but this example illustrates the depth of analysis supporting our data-dependent decision-making. Let me now turn to the measurement issues raised from the measurement issues raised by the information age to an issue that has long been at the center of monetary policy making. How tight is the labor market? Answering this question is central to our outlook for both of our dual mandate goals of maximum employment and stable prices. While this topic is always front and center in our thinking, I'm raising it today to illustrate how we're using big data to inform policymaking. Until recently, the official data showed job gains over the year through March 19 of about 210,000 per month, which is far higher than necessary to absorb new entrants into the labor force and thus hold the unemployment rate constant. In August, the BLS publicly previewed the benchmark data revision coming in February 2020, and the news was that job gains over this period were more like 170,000 per month, a meaningfully lower number that itself remains subject to revision. The pace of job gains is hard to pin down in real time, largely because of the dynamism of our economy. Many new businesses open and close every month, creating some jobs and ending others, and definitive data on this turnover arrive with a substantial lag. Thus, initial data are, in part, sophisticated guesses based on what is known as the birth-death model of firms. Several years ago, we began a collaboration with the payroll processing firm ADP to construct a measure of payroll employment from their data set, which covers about 20% of the nation's private workforce and is available to us with roughly a 1-week delay. As described in a recent research paper, we constructed a measure that provides an independent read on payroll employment that complements the official statistics. While experience is still limited with the new measure, we find promising evidence that it can refine our real-time picture of job gains. For example, in the first 8 months of 2008, as the recession was getting underway, the official monthly employment data showed total job losses of about 750,000. A later benchmark revision told a much bleaker story, with declines of about 1.5 million. Our new measure, had it been available in 2008, would have been much closer to the revised data, alerting us that the job situation might be considerably worse than the official data suggested. We believe that the new measure may help us better understand job market conditions in real time. The preview of the BLS benchmark revision leaves average jobs gains over the year through March above the pace required to accommodate growth in the workforce over time. But where we had seen a booming job market, we now see more moderate growth. The benchmark revision will not directly affect data for job gains since March, but experience with past revisions suggests that some part of the benchmark likely will carry forward. Thus, the current reported job gains of 157,000 per month on average over the past 3 months may well be revised somewhat lower. Based on a range of data and analysis, including our new measure, we now judge that, even allowing for such a revision, job gains remain above the level required to provide jobs for new entrants to the job market over time. Of course, the pace of job gains is only one of many job market issues that figure into our assessment of the economy and how it's performing relative to our maximum employment mandate, as well as our assessment of any inflationary pressures arising in the job market. In summary, data dependence is and always has been at the heart of policymaking at the Fed. We are always seeking out new and better sources of information and refining our analysis of that information to keep us abreast of conditions as our economy constantly reinvents itself. Before wrapping up, I will discuss recent developments in money markets and the current stance of monetary policy. Our influence on the financial conditions that affect employment and inflation is indirect. The Federal Reserve sets 2 overnight interest rates, the interest rate paid on banks' reserve balances and the rate on our reverse repurchase agreements. We use these 2 administered rates to keep a market-determined rate, the federal funds rate, within a target range set by the FOMC. We rely on financial markets to transmit these rates through a variety of channels to the rates paid by households and businesses and to financial conditions more broadly. In mid-September, an important channel in the transmission process, wholesale funding markets, exhibited unexpectedly intense volatility. Payments to meet corporate tax obligations and to purchase Treasury securities triggered notable liquidity pressures in money markets. Overnight interest rates spiked, and the effective federal funds rate briefly moved above the FOMC's target range. To counter these pressures, we began conducting temporary open market operations. These operations have kept the federal funds rate in the target range and have alleviated money market strains more generally. While a range of factors may have contributed to these developments, it is clear that without a sufficient quantity of reserves in the banking system, even routine increases in funding pressures can lead to outsized movements in money market interest rates. This volatility can impede the effective implementation of monetary policy, and we are addressing it. Indeed, my colleagues and I will soon announce measures to add to the supply of reserves over time. Consistent with the decision we made in January, our goal is to provide an ample supply of reserves to ensure that control of the federal funds rate and other short-term interest rates is exercised primarily by setting our administered rates and not through frequent market operations. Of course, we will not hesitate to conduct temporary operations if needed to foster trading in the federal funds market at rates within the target range. Reserve balances are one among several items on the liability side of the Fed's balance sheet, and demand for these liabilities, notably currency in circulation, grows over time. Hence, increasing the supply of reserves or even maintaining a given level over time requires us to increase the size of our balance sheet. As we indicated in our March statement on balance sheet normalization, at some point, we will begin increasing our securities holdings to maintain an appropriate level of reserves. That time is now upon us. I want to emphasize that growth of our balance sheet for reserve management purposes should in no way be confused with the large-scale asset purchase programs that we deployed after the financial crisis. Neither the recent technical issues nor the purchases of treasury bills we are contemplating to resolve them should materially alter the stance of monetary policy, to which I now turn. Our goal in monetary policy is to promote maximum employment and stable prices, which we interpret as inflation running closely around our symmetric 2% objective. At present, the jobs and inflation pictures are favorable. Many indicators show a historically strong labor market with solid job gains, unemployment at a half-century low, and rising prime-age labor force participation. Wages are rising, especially for those with lower-paying jobs. Inflation is somewhat below our symmetric 2% objective, but has been gradually firming over the past few months. FOMC participants continue to see a sustained expansion of economic activity, strong labor market conditions, and inflation near our symmetric 2% objective as most likely. Many outside forecasters agree. But there are risks to this favorable outlook, principally from global developments. Growth around much of the world has weakened over the past year and a half, and uncertainties around trade, Brexit, and other issues pose risks to the outlook. As those factors have evolved, my colleagues and I have shifted our views about appropriate monetary policy toward a lower path for the federal funds rate and have lowered its target range by 50 basis points. We believe that our policy actions are providing support for the outlook. Looking ahead, policy is not on a preset course. The next FOMC meeting is several weeks away, and we will be carefully monitoring incoming information. We will be data dependent, assessing the outlook and risks to the outlook on a meeting-by-meeting basis. Taking all of that into account, we will act as appropriate to support continued growth, a strong job market, and inflation moving back to our symmetric 2% objective. Thank you, and I'll look forward to our questions.
Thank you, Jay. And we do take cards as well as the NABE app. So I would start just to reiterate in terms of data dependency, the importance of the BEA and the VLS. And it's been a long-standing interest for NABE to support those agencies. I'm curious if you could lend your support to those agencies as well.
I'd be delighted to. Our work depends really heavily on getting timely and accurate data, and also on being able to anticipate changes in the structure of the economy. It's an ever-evolving economy, and it's not as simple as just counting the things that are happening. When we're trying to assess how tight the labor market is or how strong GDP is, it really is an important challenge that enables policymakers to do a better job for the public. So I can hardly say too strongly how much we should support that activity. I'd also like to, again, support my colleagues in the industrial production group who work behind the scenes for a century now, and also all of the other terrific economists at the Fed. I'm sure people in this room would appreciate that they work very hard to serve the public all the time, and I'd like to call that out.
So in terms of being a pilot way up in your jet plane, it's very nice to have good indicators about what, in fact, you're flying through. I'm going to ask a more general question. I got the opportunity to go up to the Rocky Mountains National Park this weekend, and one of the things that the forestry world has learned is that if you go and you fight every fire that starts in a forest, one day you get a fire that it comes out of control. And they've learned that pre-burns are actually a really powerful way of controlling big systemic risk. And I'm curious, we're more than a decade into an expansion. As you mentioned, the unemployment rate is at a half-century low. Do you think that there's any sort of fuel building up in the forest of the financial system?
Well, let me start by saying it sounds like you had a more fun weekend than I did. Let me take that question another way, and then I'll come back to your question. I do think if you look through these long expansions, the one in the 90s and the current one, there have been periods where the economy slows and kind of gathers itself and then moves forward again. That was 95 and 98, those two episodes, and that was 15, 16, and I guess also a little bit of a slowdown earlier in the mid-teens. So in this expansion. So that is that's clearly a natural, it's part of these very long expansions that we've been having really for the last 40 years. It seems to be a healthy thing. Clearly things are slowing a bit now. Growth is slowing closer to potential, and job growth is slowing as well, but it may just be gathering itself. There's no reason why the expansion can't continue. So, but in terms of the dry tinder question, we monitor financial stability conditions very carefully now, all the time. We have a division, and that's responsible for that. And 4 briefings a year, regular quarterly briefings for the board and the FOMC, and ongoing monitoring. We published our framework so that everyone could see what we're looking at and hold us accountable. Not like this, the pre-crisis system was much more financial crisis happens, call in the SWAT team and try to stop it. So this is a much more forward-looking thing. So we look at leverage in the banking system, leverage in the non-financial system, asset prices, and the stability of funding, principally in the banking system, but not exclusively. And if you look across all of those today, I would say that the vulnerabilities to the financial system are moderate overall, which is to say not low and not high. There are vulnerabilities, and there are areas that we're carefully monitoring. Particularly, some asset prices have been high, and also corporate debt is an area. So in non-financial borrowing, you have household and you have businesses. Households are actually in good shape. Businesses are borrowing a lot, and it's something we've been monitoring carefully. But again, I'd say the vulnerabilities are moderate overall.
Great. So when you first became chair, you were spotted numerous times carrying Paul Volcker's book under your arm, and I'm curious what lessons did you learn from Paul Volcker, and what lessons are you taking through your chairmanship?
I've known Paul Volcker since I was an assistant secretary in the Treasury in 1992 or 1. And, of course, at that time, he had just relatively recently left the Fed, and I was frightened of even meeting him. I was so intimidated by this global figure. And he couldn't have been nicer and more interested in, helping me and supporting me. And we kind of kept up, and he was really, it was a great person to know. And I've read I've read numerous accounts of his life, but this book, if you haven't read it, I think really sums it up really well. I don't think there has been a greater public servant in our broad area in our lifetimes. I mean, he really just did exactly what he thought was the right thing all the time, and he let the chips fall where they may. He was famously booed at a Washington Bullets basketball game when he had rates very high, and they were then called the Bullets. So he's a great man. I'm still in touch with him, and so I actually thought I should buy 500 copies of this book and just hand them out at the Fed. I didn't do that, but it's a book I strongly recommend, and we can all hope to live up to some part of who he is.
Great. So one of the things that the Fed has been doing over the past year is a strategic review of its policy framework. Just recently, we had a Brookings conference discussing inflation and inflation targeting and a reevaluation of perhaps the framework there. I'm curious how that research and review is evolving and your thoughts there.
So I think it's evolving very well. This was something I really wanted to do as part of my time as chair, and a number of central banks around the world have done these external reviews in one form or another, and I thought it would be just a good idea, a good time and a good idea for us to do it. And then when Rich Clarida arrived, there were only 3 of us on the board at that time. We were just having a hard time, getting through the day. But Rich took this on at the very beginning and has been a great leader for this. So we're looking at our framework, our tools, and our communications. We began with a series of Fed Listens events at all 12 reserve banks. I think the last one I'm attending, the last one tomorrow in Kansas City. I think we've done 14 of those, and they're very different, and lots of them are live streamed, and we're hearing from the people we serve mainly. So it's people who work and live in low and moderate income communities. It's labor unions. It's small businesses, and really what a maximum employment and price stability and growth mean to them. And I have to say, if you listen to one of these things and sit through it, it's quite striking. It really does. I think it sheds a different kind of light than we might ordinarily get just from all of the economics that we study. So we take all that on board, and now we're going through a series of board meetings at which we're looking at things like makeup strategies for inflation and our toolkit and how we communicate, and we're going through those things one by one. I think we're making great progress, and I'm hopeful that we will. I think the exercise itself is a big win and a big gain for transparency and process. But I'm also hopeful, and I believe we'll be able to come out with some innovations which will put us in a better place to serve the public. And I'm also happy to see other central banks around the world are kind of picking up on the idea and doing it. So
great. So you mentioned the toolkit, and certainly the toolkit over the last decade has expanded quite considerably for not just the Fed but other central banks. And as you consider the prospect of if we do see a full business cycle, what tools in that toolkit are you interested in using again? And then what tools do you not have in that toolkit that you hope to have?
As this audience will know well, the tools that we did use in the last financial crisis, of course, were rates, the federal funds rate, which we cut close to zero, effectively to zero. And then we also used fairly aggressively forward guidance, indicating that to the market, and this was at a time when the market was predicting lift-off and rate increases that were higher than the committee thought were appropriate, committed sort of semi-commitments to hold rates low for a long time. So that worked. And also large-scale asset purchases of longer-term securities, so which are a way of lowering long-term interest rates to support economic activity. So those are, I guess we need to stop calling them unconventional tools at some point, but those are the two new tools that we used during the financial crisis. I'm sure that we would use them again as needed and as appropriate. We don't see that now. We looked carefully at negative interest rates. I don't think that's something, I know it's something we didn't see as an ideal tool in our institutional context, and I think different central banks around the world did different things, and we can observe how those things work. But I don't think we regard that as a first order tool or something we'd be likely to use. There are other things that we need to look at, and I would say yield curve control, sort of short-term yield curve control, is something worth looking at. It's not at all something we haven't looked at it, but it will be something that we look at when the time comes. And the last thing I'll say is I think our toolkit, we'll use it aggressively to the extent we need to achieve our mandate.
So one of the questions I got from someone today who knew I was going to be asking you questions was, is there an unintended consequence of, in a sort of reasonable growth, low unemployment, near the target rate, inflation rate, is there an unintended consequence of easing into that environment? Does it actually signal a risk-off environment to participants or consumers, et cetera, and does it actually almost become a self-fulfilling prophecy?
I don't think we see that in the data. I mean, in theory, that's possible. I don't think we see it in the data. I do look at this as akin to the two instances in the 1990s when the Fed cut and then cut again and then cut a third time. In those cases, that happened to be the right thing, that they thought that was the right thing to do. So provided some support for the economy, and the economy took that accommodation on board and gathered steam again, and the expansion continued. So That's the spirit in which we're doing this. I don't see any evidence that monetary policy is reducing consumer confidence or business confidence, which seems to be focused more on other issues.
One of the dynamics over the years, especially following the GFC, was policy coordination amongst the global central banks, the BOJ, the ECB, the Bank of England, the Fed, even to some extent the PBOC. And what are your thoughts on policy coordination going forward? What systems are in place?
In a crisis situation, there needs to be obviously a lot of deep knowledge about what's going on in economies around the world and coordination where it's appropriate. So I think of the swap lines, the dollar swap lines were clearly a key in keeping dollar funding markets working. In peacetime, in times like today where we're not in crisis, we do keep in very close touch with central banks around the world, and I think that's a very healthy thing. Coordination, the first step is transparency, and we all try to be very transparent so that our moves are well understood. Coordination, I think, really arises in the state of crisis, and so we don't actively coordinate now, but we try to explain ourselves to the public and hence to each other.
One of the negative of having an electronic device that people can upvote questions is that there's a question that's getting upvoted about how monetary policy and climate change inform one another. Maybe I'll read the question directly, but any thoughts on that?
Sure. So climate change is a very important issue in my way of thinking for countries and governments to deal with around the world. As I say, it's an absolute first-order issue as far as I'm concerned. Less obvious is that it's a first-order business for central banks. I think the main responsibility for climate change now, dealing with climate change, resides with legislatures and particular agencies that are focused on the economy. However, I think we are learning that financial markets and financial institutions that are important, transmission into the economy of policies of various sorts. And central banks around the world are starting to think more about how and whether central banks should play a direct role in climate change. I'd say we're not there yet. We're not in a place where I think we would conduct monetary policy in order to deal with climate change type issues. But there's a lot of forward thinking and analysis going on. Of course, in bank supervision, we already supervise financial institutions in areas that are subject to severe weather, which is possibly related to climate change. We already require them to have plans to deal with severe weather, redundancies, and resilience to what can happen in a, for example, a hurricane. So in that sense, it's already kind of endogenous to our supervision work. But I think it's an important work, and we're going to be following carefully developments around the world on that.
So a lot of questions about the repo market, as you're probably not surprised to hear. And essentially, the question that is percolating through this room and the financial markets is, what is the repo market telling us? Why are the banks in what we're seeing in terms of the spikes in the repo markets, the need to do some intervention from the Federal Reserve, and is the Fed almost coming back into QE, or would you describe this intervention as something different?
Let's start there. This is not QE. In no sense is this QE. This is nothing like it all. This is I'll come back to that point, but I really wanted to make sure.
Yes, I
didn't want to forget to say that.
Right.
So if you go back, the quantity of reserves in the banking system peaked at about 2.8 trillion at the end of 2014 when we finished doing quantitative easing. And then due to increases in other reserves and also just to the increases in non-reserve liabilities really declined. while we held the balance sheet constant, reserves were actually shrinking down to, I guess, about $2.4 trillion, when under Chair Yellen, we began normalizing, actually shrinking the balance sheet, letting assets run off very, very gradually. So that went on. And then in March of this year, we tapered that. And in, I guess, July of this year, we stopped. And I think through all of that, we were moving quite gradually, and we were carefully talking to the banks and doing surveys and trying to assess what would be their lowest comfortable level of reserves, add all that up, and then put a big buffer on top of it. I think doing that work, checking it twice, led us to, and also watching the markets, led us to think that we were still probably away from a minimum level of reserves. And let me define what that is. We've committed to a system of ample reserves, and that means that we'll be able to conduct monetary policy, keep the federal funds rate in its range without resorting to open market operations all the time. So I think it very much looked like we were still a bit perhaps above that until September, when we found that we probably weren't.
Yeah.
And so we found that out, and so there are a number of explanations. It can be that reserves are just kind of less flexible. The quantity of reserves are less fluid, less flexible in the markets than we had anticipated. In any case, there are a number of possible explanations, and I think a plan to get us to our goal is going to need to take all of those on board over time. So we're working on just such a plan, and as I mentioned, we'll announce it soon when it's ready. It's not ready yet, but we're very much making great progress on that. And the idea will be to add enough reserves back in so that reserves will, of course, move up and down during the course of the year, and they'll also go up over time as the balance sheet expands. But reserves move around quite a bit during the course of a year. They have to be at a level so that their lowest level during the year will not be below the level that's needed to allow us to operate in an ample reserve regime. And we think that level might be at or maybe a bit above where we were in early September of this year. We think that. All of this is, though, uncertain. We're still learning. So we'll be adding reserves back in when we announce our plan to get back to something like that level. Of course, we'll continue to use open market operations to the extent we need to for as long as we need to. The main thing is this is very important for the financial markets, and we will do what we have to do to secure the transmission of monetary policy. It doesn't actually, as long as we do that, it actually doesn't have much implications for the economy, for financial conditions, or for the people we serve.
Wonderful, great. And I think that they're taking cards, is that right? Yeah, okay, if folks have cards.
But not QE, did I mention that?
Not QE, you did mention that.
All right.
You did mention that. So I will ask you the same question I asked you a year ago, which is your thoughts on the yield curve. So now we were starting to see the curve flatten a year ago. Today it is an inverted curve. And what are your thoughts at this point on what the yield curve is telling us?
You know, so the yield curve is one of a large number of financial conditions that we actively monitor. It's not, there is no single financial condition that really dominates all the others, but that's one that we certainly do monitor. And I guess we know why, we know why what short rates are doing. Short rates are really reflecting what they think the Fed's going to do. Really the question is what are longer rates saying? And they're saying a lot of different things. There's a term premium there, which is about risk on, risk off, that moves up and down in different states of sentiment, market sentiment. There's also some sort of an assessment, though, in there about what the neutral rate is in the longer run. And so we look carefully at that and try to see if we think policy is above the market's estimate of the neutral rate, then policy is tight. And so we have to sort of assess that. But, you know, so when the curve is inverted, you know, we focus very carefully on that. And it's not something that you need to deal with immediately, but it is something that it wouldn't be comfortable to be in that state of affairs for an extended period of time, of course. But again, it's one of many conditions. I hope that's what I said last year, by the way.
I think so.
All right.
I think so. All right. So the Fed has consistently characterized inflation as too low. Given that core CPI is at the highest level since 2008, and the Fed's preferred measure, core PCE, the 6-month annualized rate is above 2%, do you anticipate changing your assessment of inflation?
I would like to change my assessment of inflation. I would like to see it move symmetrically around 2%. And in PCE and core PCE terms, it still hasn't done that. We've seen it take core PCE, which is a better indicator of future inflation than regular PCE, although regular PCE is, of course, our goal. So you take core inflation, it's moved up and just kind of touched 2% and then moved back down to well below 2% in the first quarter of this year. It's now moving back up. I guess the real question is, why do we care? It's essentially, it appears to be centered a few tenths below 2%. The reason we care is not that 2 or 3 tenths of inflation really makes a big difference. The issue is more the broader context. We want inflation expectations to be centered right at 2%, and we really want to hammer that point and make sure that they are. Because we look around the world and we see disinflationary forces in Japan and Western Europe, where you see inflation moving down, expectations move down, inflation moves down, and it's been very, very hard for economies to get off that road once they're on it. And so we don't want to get on that road. We don't think we're going to be exempt to these disinflationary pressures over time. We've got an aging population, as others do. I think some of the same characteristics to our economy. So for that reason, we want to keep inflation at 2%. And it's not easy to explain that to the general public who don't really care whether inflation is 1.7 or 2%. But in our case, we think to serve them better, we need to anchor inflation at 2% so that it doesn't begin that inexorable slide down.
So when you come in to the office every day, or as you travel through your day-to-day life, I am curious what your dashboard looks like. What are you looking at on your dashboard to give you an indication of where your ship is or your plane is heading? So are you looking at, you mentioned industrial production, you mentioned productivity, inflation. Are there external factors like rest of world growth indicators? What are the things that are your touchstones that are most important on your dashboard?
You know, it's there's a lot of things on the dashboard, I would say. I try to do a deep dive on the economy mostly every weekend. I'll spend a whole day reading everything that I haven't been able to read during the week about what's going on in the U.S. economy. And that means reading the data releases and the analysis of the data releases by many of you here in this room, and also around the world, also globally, following data and following markets and that kind of thing. So that's the kind of thing you can do on a long, quiet day when you don't have meetings all day long. So that's a big part of it. I also think right now the broader sort of geopolitical risks are important right now, and you have to be watching those carefully and trying to assess the implication of those. I watch markets very carefully. I have a screen in my office where I don't sit there watching it all day, but you check in several times a day to look at what's happening in all the various markets that we all probably follow. So it's essentially, I look at everything in a way, and as I imagine many of us do.
So the Fed's role is not a social welfare role, but many would argue that the fall in the unemployment rate, the re-engagement of many people within the labor market who are out on the edges, that what we're seeing over the last couple of years has been extremely positive for the U.S. economy and the U.S. population. Is that something that is taken into consideration, that if we can continue to run the economy a little bit hot, that it could be quite a positive?
I would say that I see that aspect of the current situation as a very positive one. I guess I would question the concept of running the economy hot. I think we've learned that the unemployment rate can just be lower than we anticipated, even than 5 or 6 or 10 years ago. It's significantly lower, and yet we don't see wages rising in a way that is out of keeping with productivity and inflation. And we do see businesses saying that they see workers as scarce. We see workers saying that they believe jobs are plentiful. Those are good things. We see prime age labor force participation going up. We talk to people in those low and moderate income communities at the Fed Listens events, and they say that this is the best economy they've seen in their lifetimes. So I would say I put a very high priority on wanting to continue that. I really do. But I guess I do a little bit balk at the idea that we're running the economy hot. It just feels very sustainable. There's no aspect of the economy that is just booming. It's just, you've got a solid consumer sector where wages are going up, but they're going up right about at the level of productivity plus inflation. Job creation is healthy. There's no one sector that is, that like a housing bubble. There's nothing like that. There's no financial bubble. So it's a fairly sustainable economy. There are concerns around, business investment and manufacturing and trade, of course. But I would say we don't get to see the 11th year of an expansion very often. And there's a lot to like about it, particularly for people at the lower end of the wage scale who are getting now the highest increases. And it would be great to see it continue.
Right. So one of the, if we look at the markets, we see that the purchasing of insurance to hedge inflation risk is at all-time lows or extremely benign. But at the same time, we're in the midst of starting to increase tariffs on China. We're seeing several rounds that are going to come through. As that starts to show up in the CPI prints, et cetera, how does the Fed respond to those?
I think the basic approach to that for me would be that an increase in tariffs is, if it flows through to the consumer, is perhaps a one-time increase in prices, which is a different thing from inflation. As long as one-time increases in prices don't carry through into inflation expectations, then you don't actually have an increase in inflation. So now it's clear that if you look back at the history of the 70s with the oil crisis, some of those shocks can affect, if they're sustained and repeated, they actually can get into people's inflation expectations. We're a long way from that, though. If you look around the world, disinflationary pressures everywhere you look in advanced economies. It feels like the problem of this era is to keep inflation from moving down and try to keep it at 2%. Now, of course, if that changes, then we'll know it pretty quickly and we'll know what to do.
Great. Well, Chair Powell, thank you very much. We really appreciate it.
Thank you.
Good afternoon. Welcome to the closing bell, everyone. Chair Powell just finishing up, as you heard. Let's break down the key headlines. The Fed will begin asset purchases again, though Chair Powell saying, quote, "This is not QE in no sense at all." He said it was directed at solving recent technical issues related to the repo market rather than materially affecting the stance of monetary policy. He said they will act as appropriate to support continued growth, a strong jobs market, inflation moving back to our symmetric 2% objective. And the result of all this has been a steepening of the yield curve. Earlier today, it had been flattening. We now see, though, on the day, the 10-year and the 30-year yields higher, the rest of the yield curve slightly lower, and that supported equity markets as well, which came off their lows. The low of the session was down over 300 points on the Dow. We got up to down only 60 points before the market took a turn south on news from the State Department that they would be introducing a waiver, a visa waiver on certain Chinese citizens. As we stand, we are down 0.6% on the Dow.
And let's get over to Kayla Tauscher. She does have more on these China visa headlines that did hit the market and moved it while Chair Powell was speaking. Hi, Kayla.
Hey, Courtney, we got an announcement from the State Department that it is placing visa restrictions on certain Chinese